What I'd like to do initially is say something about what the Systemic Risk Council is, where it came from, what it tries to achieve, and how we're expanding our presence and focus on Europe. Then I'm going to say something about the reform program, the regulatory reform program, and in particular about resolution, where I may strike a different note, I suspect, from my friend Avinash. And what I'm going to try and do is to connect the reforms that try to break the too big to fail problem with exactly what Christoph has just been talking about, which is the importance of diversity and competition in the banking system. We're now about 8 years since the crisis began in the summer of 2007, triggered, announced really, by the suspension of redemptions by a credit fund down the road in France and the failure of 2 Wall Street managed hedge funds in the United States. And throughout that summer, where there was a liquidity crunch and my old world, central banking, was pushing liquidity into money markets as best they could, everyone was slow to appreciate, or nearly everybody was slow to appreciate, that the underlying problem was one of the solvency of the banking system, that the equity layer was too thin, and that in this continent this would bring forward exposing the fault lines in the design, construction of the monetary union, and that in turn would reveal the problems in the European financial system, which it did. And although that's 8 years ago, for what it's worth, I think we're only about a third of the way through to adjusting to a new, sustainable, steady state. And people sometimes are bewildered, even angry when I say this, because that means I think that it will take about a quarter of a century from 2007 to get back to some kind of new normal, which is obviously a very long time. Well, the reason I think that, I guess, is threefold. First of all, the reform program isn't yet complete, and I don't quite see how it could yet be complete, given how much there was to do, and given the desire, rightly, to do it internationally, globally, in a joined-up way, to try and dilute the forces of regulatory arbitrage. Secondly, even when the package is finalized, it will take years for business models to adjust, even if what I go on to say about resolution is exactly right in terms of the market forces it will unleash. It will take years and years for those market forces to reshape finance. But thirdly, and most profoundly, I think, for our continent, the financial system and its relationship with the economy won't reach an equilibrium until the economy itself has reached a new macroeconomic equilibrium. The only way out of this is to make the losses go somewhere else. If the losses don't go to the taxpayer, they have to go somewhere else. And the core of they have to go somewhere. And ultimately, they go to households. There are only households, as economists are fond of saying. It's how they reach households. Do they reach the households as taxpayers, in which case we're entirely reliant on supervisors and regulators, or does it reach households as investors in insurance companies, mutual funds, pension funds, as bondholders? And that is the core of the policy. And to make this policy work, you need three things. The authorities need the necessary powers. And in the EU, the Banking Recovery and Resolution Directive, which Michel Barnier and Sharon Bowles led, is a good directive. In some respects, it's better than the American legislation, benefiting from being finalized a few years later. I'm not going to say anything about that because I think the directive itself is in pretty good shape. I kind of would say that because I chaired the body that drew up the global standard, but it's what I genuinely believe. The second thing you need is you need the capital structure of banks to be such that the authorities are prepared to use the powers that the Parliament and the Council have given them. And thirdly, you need a culture amongst the resolution authorities where they will act as soon as it is clear that an institution is doomed, rather than hanging on. Now, so there are rumors, and I don't know whether they're true, there are rumors that the flesh is weakening in this continent. And I think this would be, I don't know whether it's true, but if it were to be true, I think it would be momentous for the welfare of the citizens of this continent, for the future shape of finance, and for the standing of our continent in the world. And I'm slightly struck that there's as great an awareness of these rumors elsewhere in the world as I think there is actually here in Europe. The core of it is this, that if you're going to put the losses onto bondholders, then as a matter of due process, what Americans would call rule of law, it is important that those bonds don't rank equally with other creditors, with trade creditors, with uninsured depositors, with all the people that are creditors to banks, professional and retail, but where their liability they hold is part of an operational service rather than a pure financial investment. So this requires subordination of bonds. That's the first thing. The second thing it requires is that the people that hold those bonds are professional investors, which in turn requires that retail investors are told repeatedly by securities regulators that bank bonds of the kind I'm describing are risky. They're not some nice annuity income. It's a risky investment where they will take losses in the event of a bank failure. And finally, it requires that there's enough of these bonds to recapitalize a bank when a bank's equity is wiped out. So one of the rumors is there is nervousness about requiring subordination. And if true, I think this is the most important of the rumor, because I genuinely believe that in those circumstances, the resolution project would be gravely imperiled, and we would be back to a world of bailout. And that's because if the authorities are faced with having to bail in not only the bondholders, but the uninsured depositors and trade creditors, the people that provide the groceries and the milk, I don't think they'd be prepared to do so. And if they exercise what may be a technical legal power to cherry pick on a grand scale, I suspect that they will face legal challenge and appeals for injunctive relief during the course of a resolution, which I think would bring about chaos. Remember, this is kind of knife-edge stuff. So if that were right, we're back to bailout. But except that it's worse than 2007, because now the fiscal position of many of the states around not only this continent, but elsewhere in the world, are stretched. There aren't so many states that could afford to bail out their banking systems. And so if that becomes realized, that's going to be a further reason for delaying investment, a reason to charge government more for credit, to push the ECB to intervene in government bonds even more to mask the underlying risks, delaying and weakening recovery and standing in our continent. And so my message today is that I hope that the rumors have no basis in fact, in which case I've wasted your time, but I shall be delighted to have done so in a way. But if they have any basis in fact, I think all of you, please go out there and, there must be subordination. There must be sufficient of these bonds in issue. The FSB policy on that is pretty good. And resolution authorities, the resolution authority for the banking union in particular, must be prepared to act early. I haven't debated this, but it is important that we have not only a de jure but a de facto empowered resolution authority here in Brussels. Now, if that works, let me be more positive and kind of bridge to the next panel session. If that all works, this is transformational in the long run, because bank bond holders will start charging for the riskiness of banks. They'll start asking banks to publish more information and reveal more information about the risks they're taking. When I was in office and I was involved in this work, I asked a few people around the world, who are the top 10 bank analysts in the world? I think with one exception, every single one of them was on the equity side. If this question is asked in 25 years' time, we will know that we have made real progress with the too big to fail problem if approaching half the list are on the bond side. And if that's the case, the terms of trade for banking will be altered. And that will be good for the industry as well as good for the people, because it will allow market forces to work, and it means that the instincts to stand in the way of competition, to maintain barriers to entry, can be relaxed. And those are circumstances in which technical progress in the sense of technical innovation in the sense of IT becomes technical progress in the economist sense and starts to push up productivity growth. And that's the strongest claim I'm making. I am saying that solving the too big to fail problem is a necessary precondition in our continent to starting to cure the productivity growth slump that we face. And so the stakes are very high in this peculiarly technical area, and you all need to be on it. Thank you very much indeed.